Come to question number 23. DEF Limited acquired 100% shares, no non-controlling interest, on 1st October 2011. On 31st March 2012, the summarized SOFPs of the two companies are given below. Now, first thing we should understand in such problem, date of acquisition is 1st October, year ending date is 31st March. So current year will be divided between, current year profit will be divided between pre and post in the ratio of 6 months, 6 months, 1:1. On 31st March 2012, the summarized SOFPs of the two companies were as given below. Assets, PPE, land and building, plant and machinery. Investment in XYZ. Inventory. Financial asset. Trade receivable. Cash. Total. Equities and liabilities. Share capital. Share of rupees 100 each, fully paid. Other equity, other reserve. Then under other reserve, retained earning. Financial liabilities, under that bank overdraft, trade payable, total. The retained earning of XYZ Limited showed a credit balance of rupees 3 lakh on 1st April 2011, out of which a dividend of 10% was paid on 1st November 2011. So what is the retained earning of this company on 1st April 11? 3 lakh. And out of which a dividend of 10% was paid on 1st November. So out of 3 lakh, dividend of 10% of 20 lakh. How much dividend has been paid? 2 lakh. So what is the net profit of the company? Left out of opening balance 1 lakh. And closing profit is 8 lakh 20,000. So what is the profit of this year? Can you guess what is the profit of current year? How much profit they have earned in the current year? 7 lakh 20,000. 7 lakh 20,000. The difference between 1 lakh and 8 lakh 20,000. So this 7 lakh 20,000 will divide in the ratio of 6:6. Okay. Is this calculation correct? 3 lakh was the opening profit. Opening profit 2 lakh has been used. So the opening profit remaining is 1 lakh and closing profit is 8 lakh 20,000, which means the current year income is 7 lakh 20,000. This needs to be divided in the ratio of 6:6. Next line. It says that DF Limited has credited the dividend received to retained earning account. So that is correct. Profit dividend received has to be credited to P&L account or retained earning account. So no rectification required here. Fair value of the plant and machinery on 1st October 2011. Which date? 1st October 2011. Is given to you. Plant and machinery 20 lakh. Fair value of plant and machinery is 20 lakh on this date. Okay. And you are given the balance sheet on 31st March 12. So you can't compare the balance on 31st March 12 with balance on 1st October. Then it says the rate of depreciation on plant and machinery is 10%. So in order to calculate the fair value gain or loss, you will have to make a complicated adjustment. What is the plant and machinery closing balance given to you? 13,50,000. But these two are not comparable. So first you have to find out what was the value of plant and machinery on 1st April 11. Depreciation rate is 10%, which means this is 90% of the opening balance. So 13,50,000 divided by 90% if I do, I'll get balance on 1st April 11. How much is that? 15. And then 15 lakh minus depreciation for 6 months. 15 lakh minus depreciation for 6 months will give you the book value on 1st October. The difference between 20 lakh and that book value is fair value gain on the date of acquisition. But one more side effect. Now you should provide depreciation on 20 lakh for 6 months. But you have provided on 15 lakh for entire year. So total depreciation provided in the second half is 75,000. 1,50,000 divided by 275,000. So you need to provide some more depreciation in the second half. So that will affect my post acquisition profit. Okay, so we'll do the calculation later, but I hope you have understood. First you find out the gain or loss on this date by finding the book value. Then you find out the short depreciation by comparing what you have provided and what you should have provided. Next paragraph. Following are the changes in fair value as per the respective IFRS from book value on 1st October 2011, which is to be considered while consolidating the SOFP. Now these are the increase in value of 3 items given. Trade payable increase, tick mark, trade payable, tick mark, plant and machinery. Then land and building 10 lakh, inventory 1,50,000. Depreciation rate on land and building is not given. So what we'll do? Ignore. Right? Prepare the consolidated SOFP. Question is very easy. One dividend adjustment is new. One depreciation on revaluation is a new working note for us in this example. Okay. So now first you understand what are the formats you will draw. Main formats: consolidated SOFP as on 31st March 20x2. Then after that you have consolidated statement of changes in equity. Okay. Then you have workings. Analysis of profit, calculation of goodwill. And one more working note in this problem is change in fair value of plant and machinery. Change in fair value of plant and machinery. Three working notes we will prepare. Ready? So should we start now? Say yes. Property, plant, equipment. Land and building. Right, land and building. 15 lakh plus 18 lakh. Read the adjustment below. What is the increase in the value of land and building? 10 lakh. So 10 lakh more you add. So my total will become 15 plus 18 plus 10. 43 lakh. Right, 43 lakh. Then second effect of this 10 lakh, you write in analysis of profit. Keep the first about 5-6 lines blank, then write. Fair value adjustments. Under that, write first land and building. Pre-column 10 lakh. What about plant and machinery? Come to the plant and machinery, SOFP. Parent company is 24 lakh. Subsidiary 13 lakh 50,000. Wait. In subsidiary company there are adjustments. So I'll go to working note 3. This is working note 3. We have to find out how much is fair value gain or loss and how much is additional depreciation charged. Okay. So first you write down book value as on 31st March 12. What is the book value on 31st March 12? 13 lakh 50,000. Then you can write book value on 1st April 11. 13 lakh 50,000 divided by 90%, because depreciation charge is 10%, 15 lakh. Then you write one more thing, book value as on 1st October 2011, 15 lakh minus 15 lakh into 10% into 6 by 12. That comes to 75,000. 15 lakh minus 75,000 comes to 14 lakh 25,000. This is the book value on that date. Then write down fair value on 1/10/11. How much is given below? 20 lakh. Point number E. Fair value gain D minus C, 5 lakh 75,000. Point F. Depreciation to be charged on 20 lakhs at 10% for 6 months, 1 lakh. And point G, depreciation already charged. Depreciation already charged in the last 6 months. Write down depreciation already charged in the last 6 months, 75,000. Therefore, short depreciation. How much is short depreciation? 25,000. Short depreciation 25,000. So now we have to give these two effects. Increase in value 5,75,000 plus depreciation 25,000 less. So first you come to SOFP, PPE, add 5 lakh 75,000 minus 25,000. This is depreciation, this is gain. So what is the final figure? Again 43 lakh. And then you come to this fair value adjustment in here also. Right, fair value adjustment, plant and machinery 5 lakh 75,000. Keep 2-3 lines blank. Depreciation on Additional depreciation on plant and machinery. How much? 25,000. Okay, so this completes plant and machinery adjustment. Investment in XYZ. Where will you write? Goodwill. Write in the cost of acquisition. How much is the cost of acquisition? Is it 34 lakh? And then inventory. Do we have adjustment in inventory? Yes. There is a small adjustment printed below. Inventory will increase by 1,50,000. So take on your calculator 12 lakh plus 3,64,000 plus increase 1,50,000. How much? 17 lakh? 14,000. And what about the second effect of this increase in inventory value? In the fair value adjustment, right? Inventory. Now trade receivable. Check whether there is any adjustment in trade receivable in this problem. No. So trade receivable, right. Tell me the total directly. 9 lakh? 98,000. Cash and cash equivalent. Tell me the total directly. 2 lakh? 25,000. Then come to liability side. Share capital, right first here in the inner column. Parent company 50 lakh. And what you do, you also write in SOCIE share capital opening balance. Is it 50 lakh? And what will you do with that share capital of subsidiary? Goodwill. How much? 20? 20 lakh. Now next is other equity. Other reserves 24 lakh. Parent company other reserve. Statement of changes in equity. There is a column other reserve. How much? 24 lakh. And retained earning 5,72,000. That also right here. Parent company is over. Subsidiary has to be handled carefully. Okay. Subsidiary company other reserve. Now there is a small area of doubt they have left. Whether this other reserve, is it pre, post, or partly pre and partly post? No comment on other reserve of subsidiaries given in the problem. So we will assume it is brought forward from previous year. And if it is brought forward from previous year, then it is pre-acquisition because shares were acquired on 1st October. So we can assume it is brought forward figure. So write down 10 lakh here. What about the retained earning 8,20,000? Huh? Retained earning pre 3 lakh. In bracket write before dividend. That means we have reversed the dividend. 1 lakh is the profit left out of pre-acquisition plus 2 lakh dividend added back. 3 lakh. And current year write down 6:6. How much is current year profit? 7,20,000. 7,20,000 in the ratio of 6:6. 7,20,000. Now wait a minute. Some understanding is required. Total profit you are writing here is 3 lakh plus 3,60,000 and plus 3,60,000. So how much is that? It comes to 10,20,000. But your SOFP figure is only 8,20,000. Why there is a difference of 2 lakh? Dividend. So that dividend is paid by subsidiary and received by parent company. So that dividend needs to be adjusted in the SOCIE. So right here in the SOCIE, less intercompany item, dividend received from subsidiary, from retained earning of parent reduce 2 lakh. They have received the dividend. Okay. The effect will get nullified. How the effect will get nullified? Understand. Since I have written 2 lakh rupees dividend here, dividend is an uneven item. Dividend is an uneven item. So the total profit of the company last year plus current year 10,20,000. And if I pay dividend 2 lakh, to whom it will go? Parent. Who will also enjoy this profit? Parent. So when I will write the total below, it will go to parent. So parent has received the dividend. So second effect of that dividend paid, what we will do, will directly reduce it from parent's retained earning. So that effect will get nullified. Okay. So in other question also will follow the same technique. Dividend is paid by subsidiary. Reduce it from parent share. Reduce it from NCI share. Either you have to pay in the analysis of profit or you have to pay here. Okay. In this problem, NCI is not here. So effect of NCI of course will not come in this problem. NCI is 100%. NCI is 0% here. Because they share the profit also, no? Because they share the profit here. So if they share the profit, dividend paid will be reduced from them. This profit is before deducting the dividend. By reversing the dividend here, this profit is before dividend payment. So if dividend has been paid, it means parent and NCI have received. So there should not be double effect. You are getting the profit also and then you will be getting the dividend also. So dividend effect we will eliminate. Okay. Now come to next line. Up to which point we have covered? Retained earning we have covered. If subsidiary has paid the dividend, add it to the profit of subsidiary, which we have done, and deduct it from parent and NCI share, their respective share in the dividend received. In this question, one party is not there, NCI. So entire dividend is adjusted in parent. Retained earning we have done. I'll come back to that working again. Now just quickly add trade payable, but before trade payable, bank overdraft 8 lakh. Trade payable has a small adjustment. If you see below, 4,41,000 plus 1,74,000, and there is a fair value adjustment also 1 lakh. So total trade payable would be 7,15,000, and this 1 lakh increase in trade payable, fair value adjustment, positive or negative? Negative. Right here. So all SOFP items are over. Adjustments are also over, but I'll just read it again. The retained earning of XYZ Limited showed a credit balance of 3 lakh. That is, we have done here 3 lakh, out of which a dividend of 10% was paid. That we have adjusted. Then write down on 1st November, DF Limited has credited the dividend received to retained earning. Fair value of plant and machinery was 20 lakh, done. Depreciation 10%, done. Following are the change in fair value as per respective IFRS, done, done, done. Done, done, are done. So tell me the total of pre-acquisition. 32 lakh? Sure. 32 lakh 85,000, is it right? Say yes. And second column? 3 lakh 35,000. Then you write down DEF Limited. DEF Limited 100%, 3 lakh 35,000. And this figure 32 lakh 85,000, you write in pre-acquisition profit. So anybody for goodwill or capital reserve? Goodwill or gain on bargain purchase? Right, gain on bargain purchase. Gain on bargain purchase 18 lakh. Gain on bargain purchase 18 lakh 85,000. Okay. So this figure I will transfer to SOCIE. Correct. Right here, gain on bargain purchase 18 lakh. How much? 25. 85. And post acquisition profit 3,35,000. So now what you do? Tell me the total first, horizontal total. 50 lakh, 5 lakh 72,000 and 24 lakh. 79 lakh. 72. Okay. Then 2 lakh. Then 18 lakh. 85,000. 3 lakh 35,000. So let me complete the table now. 50 lakh. What is this total? 25 lakh. 92,000. Last column total 99 lakh. 92,000. Okay. This is share capital. What is the total of these two reserves? 49 lakh. Right here, 49 lakh 92,000. Okay. So let us write down share capital. I think I have already written 49 lakh 92,000 right here. Nine 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 two triple zero. Tell me the total of the 1 crore 15 lakh 7,000. Is it 1 crore 15 lakh 7,000? What is the total? Yes, first bench. 1 crore 15 lakh 7,000. Asset side. Asset side is 1 crore 15 lakh 37,000. Okay, there is a small typing error in trade payable. Trade payable, this is 4,71,000. Now just check, is it matching? Trade payable, if you check the total, it is not matching. Trade payable, make it 4,71,000. So what is the trade payable final figure? And this is 1 crore 15 lakh 37,000. Now you make a small working. Okay. In this previous question, 23, write one more working note for calculation of current year's profit. Calculation of current year profit. That is not 7,20,000. We have not written how it has come. Okay. Profit balance on 31st March 12 is 8,20,000. Profit balance on 1/4/11 before paying dividend was 3 lakh. Before paying dividend was 3 lakh. And then write down less dividend paid out of 3 lakh. Dividend paid was 2 lakh, 10% of 20 lakh. So opening profit that is remaining in retained earning account is 1 lakh. Okay. Therefore, current year's profit is 7,20,000. That we have written in the answer. Current year profit 7,20,000 apportioned in 6:6 ratio. And this dividend that we have paid 2 lakh, we have adjusted in retained earning. This answer is over. Okay, now come to next question. 24. On 31st March 2012, underline the date, Blue Heavens Limited acquired 100% ordinary shares carrying voting rights of Orange County Limited for rupees 6,000 lakhs in cash, and it controlled Orange County Limited from that date. The acquisition date statement of financial position of Blue Heavens Limited and Orange County Limited And the fair value of the assets and liabilities recognized on Orange County Limited statement of financial position were. Now see the way the question is presented. Blue Heavens Limited carrying amount is given. Orange County Limited carrying amount is given. But there is fair value also given. Right. So while calculating goodwill, will take fair value. Second, while preparing the SOFP, consolidated SOFP, will take the fair value. Okay. So some figures we will not use in our answer. Carrying amount of Orange County we may not use in the answer for some assets and liabilities. So start assets, non-current asset, building and other PPE. Investment in Orange County 6,000. Same 6,000 is mentioned above. Current asset, inventory, trade receivable, cash, total, equity and liabilities. Then equity, share capital, retained earning, current liabilities, trade payable, total equity and liability. Prepare consolidated SOFP of the group. Now, what is the date of acquisition in this problem? 31st March 2012. What is the date of consolidation? 31st March 2012. Is there any post-acquisition period? No. So, whatever adjustment is there is pre-acquisition adjustment. Okay, all fair value adjustment will be treated as pre-acquisition adjustment. So this is just a simple problem, but then this problem has a second part, question 25, and it has a third part, 26. So 3 questions they can combine in one problem, one by one, and maybe you will be tested for a good 40 marks. Okay. So the 3 problem will solve one by one. So first you understand what are the formats we will require. This is just simple consolidation problem. Here we don't have adjustment. Only for goodwill calculation take fair value wherever given. So first we will prepare consolidated SOFP on 31st March 20x2. Then we'll prepare one consolidated statement of changes in equity. And one more statement will prepare calculation of goodwill. It's a 100% subsidiary. NCI is not required. All profits are pre-acquisition. So that pre-acquisition adjustment I am directly going to do in the goodwill working only. Or you want to make one more separate working? No, you can do here only. Yes. So if you are smart enough, we can start solving immediately because we don't have much of work to do. Dear student, start. Wherever fair value is given, take fair value. Okay, and give me the answer fast. Property, plant, equipment. You will take 7,000 plus which figure? 3,300. So 7,000 parent company as it is, and plus 3,300 subsidiary. So how much you are getting? 10,000? Right. 10,300. Then continue. You have investment in Orange County Limited. This you will write in goodwill calculation. Consideration paid is 6,000. Then we have current asset, inventory, trade receivable, cash. So take inventory. How much will you take? Inventory will be 700 plus 600. Is it 1,300? Trade receivable 300 plus 250, 550. Cash 1500 plus 700, 2200, 2200. Okay, then come to fair value adjustment. We have adjusted three figures: this property, plant, equipment, inventory. Two figures we have adjusted so far, yes or no? So write in this goodwill working also, fair value adjustment, building and other PPE. How much we have adjusted in building and other PPE? 300. Write 300 here. And then we have also adjusted inventory. How much we have adjusted in inventory? Write 100. Other two items we have taken at book values. Then you come to equity and liability side. Equity and liability, share capital, write 5,000. Other equity, 10,200. We'll first write in this format. Share capital 5,000 and retained earning is 10,200. Then subsidiary share capital, right here share capital 2,000 and 2,300. Then trade payable. Trade payable has an no adjustment. Take total, tell me the total directly. 450. Write 450 in the last column. All adjustment we have done. And then you come to calculation of goodwill. Consideration paid written, NCI is not there. Share capital, pre-acquisition profit and fair value adjustment. So first you tell me the total of these four items. How much is total of this 2,000 plus 2,300 plus 300 and plus 100? 4,000? Is the student right? 4700. So therefore we will get goodwill 1,000 is right. And complete this table also. 5,000 plus 10,200. 15,000. Do we have any post-acquisition item here? No. So copy the same numbers again. 5,000, 10,200, 15,200. So now this answer is almost over. How much you said goodwill? How much you said other equity? 10,200. So total in the outer column 15,000, 15,200. What is the total of your SOFP? 15,650. Tallied. Go to next question. Next question we will solve quickly. It is an extension of this problem only. Okay. The facts are same in the above question, same as in above question. However, Blue Heavens Limited acquires only 75% of the ordinary shares. So this time there will be NCI also. Now tell me, in the previous question we had paid 6,000 for 100% share. So for 75% share they have written also, to which the voting rights are attached to Orange County Limited. Blue Heavens Limited pays rupees 4500 for the shares. Previously, how much they had paid? 6,000. So, how much they saved if they buy only 75%? 1,000. Which means in our previous SOFP, cash and bank balance, which was used to make the payment, will change. Add 1500 in the cash and bank previous question. So previous question, cash balance of Blue Heavens was 1500, but for this question it will be 3000. But for this question it will be 3000 because you are not going to pay 6000 cash, you are going to pay only 4500. So cash balance of the parent company will be now higher by 1500, and the cost of acquisition, which is given 6000 in the previous problem, will be 4500, and you will have some NCI also in your answer. Is it right? Prepare the consolidated SOFP. Now, dear student, they have not mentioned how to value NCI. Is it mentioned? So there are two possible answers. If you use fair value, you will have one answer. If you use the proportionate share in net asset, you will have another answer. Is it mentioned anywhere how will NCI be valued? Fair value is not given. 6,000 is the 100% value. You can take one of the two options. 1500 you can take, or you can take proportionate share in net asset, which we had calculated here. Net asset is 4700. So we'll take proportionate share in net asset. Because see, if you are buying 75% share and if you are buying 25% share, the answer is not in practical world proportionate. Because for 75% share, you can pay premium. But for 25% share, you will not pay that much amount of premium. So therefore, practically speaking, the non-controlling interest is not proportionate to parent share 75%. Okay. But still, for classroom and exam, one can assume that NCI is also proportionately valued based on the fair value of parent proportion. Okay, so let us start. This time we'll have one consolidated SOFP, statement of changes in equity, and one NCI also. So there is one NCI column in your notes? Yes. So dear students, start. So tell me the figures from previous answer only. PPE was how much? PPE was how much previous answer? 10,300. Goodwill we will calculate again. Don't worry. Inventory total was how much? 1300. You can copy from previous answer. Trade receivable was how much? Trade receivable 550. Only one figure I am going to change. Cash. Cash was given to you 1500, but that 1500 will become 3000. 1500 plus 1500, parent company, and subsidiary was as usual 700. So my total cash balance will be 3700. Then come to equity. Share capital 5000. Other equity 10,200. It won't change because this is only parent. Then NCI we will calculate. Trade payable total was how much? 450. Up to this any query? Come to this statement of changes in equity. That also complete. 5,000 right here, share capital. Parents retained earning was how much? 10,000. Wait. NCI, wait, we'll write something. Goodwill. Consideration paid this time will be 4500. NCI will write later. Fair value of identified net asset as per previous problem was how much? Do you remember 4700? So NCI share will be 25% of 4700. How much is that? Take this total first. 5675 minus 4700. So how much is goodwill now? Is it 975? Come to NCI. Write NCI here 1175. Tell me this total now. 16,000. 375. Post acquisition is not there. So copy the same figures again. In the main answer, write goodwill 975 and other equity I have written. NCI was how much? NCI right here 1175. Okay. Now just check the total of asset side. 16825. Check total of the liability side. 16825. So just remember this cash balance we have increased. For 25% of 6,000 we have saved. Write one assumption. Assumption right. NCI is based on proportionate share in net asset. NCI is based on proportionate share in net asset of subsidiary as on the date of acquisition. Any query on these two questions? 24, 25. Now this 25 number will be used in 26 number. 26 is now an extension of 25. So whatever adjustment we have done here will be applicable there also. So keeping that in mind, solve 26. Facts are same as in above questions. Blue Heavens Limited acquires 75% of Orange County Limited, which means this balance sheet is the opening balance sheet, what you see on the screen right now. Is it right? And then Blue Heavens Limited paid 4,500 lakh for the share. That is also done. On 31st March 2013. On 31st March 2013. That means after 1 year. Now this is the given SOFP after 1 year. On 31st March 2013, that is 1 year after Blue Heavens Limited acquired Orange County Limited, the individual statement of financial position and statement of comprehensive income of Blue Heavens Limited and Orange County Limited were. So now again they have given you first SOFP which is on 31st March 13, that is 1 year down the line. And below that, if you see, there's a statement of comprehensive income, means you can say profit and loss statement. Asset side, non-current asset, building and other PPE. If you look at the Orange County column, it is 2750. Whereas in the 24th number question, the book value was 3000. So 3000 is the PPE at the beginning, book value. They have not done the revaluation that we are doing for consolidation purpose. Minus 2750, it means they have provided some depreciation in this year. How much? 250 they have already provided. But if I use revaluation, then it should be 3300. So on 300 we should have provided more depreciation. That they have not provided. So on 300 will provide depreciation. Number of years are mentioned somewhere below. So wait. Next line. Investment in Orange County. No, the numbers they have given below. Years are given. Inventory, trade receivable, cash, total assets, equity and liabilities, share capital, retained earning, current liabilities, trade payable, total. Comprehensive income statement for year ended 31st March 2013. Blue Heavens Limited, Orange County Limited. Revenue, cost of sale, gross profit, administration expense, profit for the year. Note, Blue Heavens Limited is unable to make a realistic estimate of the useful life of goodwill, and consequently the useful life is presumed to be 10 years. No, wait. Blue Heavens Limited uses straight line amortization method for goodwill. Not ignore. If it is given, we'll provide. We'll assume goodwill is being impaired 1/10 every year. So instead of amortization, you use the word impairment. Goodwill is impaired 1/10 every year. The fair value adjustment to building and other PPE. Wait, the fair value adjustment in building and other PPE is in respect of a building. The building have an estimated useful life of 20 years. So what is the use of this data? That additional 300 that you have increased in PPE, divide by 20. So how much additional depreciation you will have to provide? 15. So tick mark building and other PPE item. That will be depreciated by 15. Additional depreciation. So there will be two adjustments in that. First you will increase it by 300 and you will reduce it by 15. 300 you have to appreciate because of fair value adjustment, and 15 additional depreciation. Next is Blue Heavens Limited uses the straight line method for depreciation of PP. All the inventory held by Orange County Limited on 31st March was sold, 31st March 12 was sold during 2013. So that opening inventory where we had done the adjustment in question number 24. Go to question number 24. In that question number 24, if you see, you have increased the inventory value by 100. So while calculating the cost of sale, tick mark cost of sale, my cost of sale will increase by 100 rupees because the opening stock will increase by 100 rupees. Cost of sale of subsidiary, which is 1000 rupees given in the problem, will increase because you have made a fair value adjustment. Okay, and the inventory was sold in the current year. So in the pre-acquisition period, will make an adjustment of 100 plus, and in the post-acquisition period, this inventory has been sold. So we'll give the effect in the post-acquisition period for the sale of the inventory also. So now it won't affect my balance sheet. It will affect my pre-acquisition and it will affect my post acquisition as the inventory has been sold out. Next line, prepare the consolidated SOFP, but we'll also prepare the consolidated statement of comprehensive income because we need to find out the NCI figure and parent share, right? So first we will prepare consolidated SOFP as usual. Then we'll prepare consolidated statement of profit and loss. So in this question, what I have done, I have just kept the depreciation line separate. We will remove depreciation from administration expense and put it separately. If you can adjust in administration, that also it's okay. Then one consolidated statement of changes in equity. This time we will have a post acquisition adjustment also, because there is a 1 year gap and 2 more working: analysis of profit and calculation of goodwill. So calculation of goodwill will just copy paste from the previous answer, right? So now we will continue tomorrow.